shares in Prairie Sky holding their own today. The stock up about 3%, and it's not a thrilling day for oil. The company, of course, owns land that it charges royalties on when oil and gas companies drill and produce on it. They're in Western Canada. We're joined by the President and CEO, Andrew Phillips. Thanks very much indeed for joining us, Andrew.
Thanks for having me.
One item of interest here, you had record oil volumes in your latest quarter. Why was that?
Yeah, we've had, since Trans Mountain went on, there's excess capacity in Western Canada, and we've seen drilling to kind of fill those pipelines over time. And we have some of the more economic heavy oil plays in the world in Canada, and a lot of those have been actively drilled recently. And so we've seen some very nice growth out of the business organically over the last 3 years.
You're about half and half, natural gas and oil, roughly?
We'd be roughly 63% oil and liquids and then 37% natural gas. But amazingly, with natural gas as weak as it's been, it only represented 8% of revenue in the past 6 months.
Sorry, give us that again. What was it? Gas was only 8% of revenue?
That's correct, even though it's 37% of production. So it's, over time, that'll recover. But in the meantime, it's a very low level of revenue, even though it's a fair amount of production.
That's interesting. Maybe we can have a look at tourmaline as a measure of sentiment, a TOU, a one-year chart. I mean, it's the first stop for many people when they buy natural gas. There is optimism over natural gas in Western Canada when and if the LNG and other export projects kick in.
For sure, and tourmaline's a great example. They're a wonderful low-cost producer and do an excellent job. I think they're one of the best natural gas companies in all of North America, so we're fortunate to have them in Canada. And I think those strong low-cost producers definitely win in this environment.
The Raymond James has a hold on your stock because they warn that we feel that oil-weighted producers are likely to temper development with this weakness in crude prices. Are you seeing that? Are you seeing a reluctance to spend on the part of oil companies?
Yeah, it's interesting. It's the near-term drop in pricing obviously hasn't been reflected in people's capital budgets yet. I think we're heading into a period of spring breakup where the road bans go on. So there probably will be some adjustments. One of the places we're fortunate is that we've invested in assets that are with low-cost producers, and they have some of the best recycle ratios in the business. So their finding development costs are well below even where current prices are. So they're able to drill through this and still earn a very good profit and very good returns in the field. And the other big difference when you think about COVID versus today is the producers themselves are in very good balance sheet positions. So while there will be some adjustments for sure for the higher cost producers, I think on balance, it'll be a little more muted depending on where oil price actually lands.
You haven't got much debt, and of course that frees you to buy back stock. And you did an outsized buyback in Q1, about $90 million worth of stock.
That's correct. Yeah, we've returned $2.5 billion to shareholders since our IPO. Some of that through over $2.2 billion in dividends, and then the balance through buybacks. And I think one of the interesting things about our business is you don't get too excited about $100 oil. You don't get too down at $60 oil because it's a 40-year reserve life index, and you really care about what the average price is over longer periods of time. So the actual value of the business doesn't change much, even with short-term changes in pricing. So it just gives us an opportunity to buy the business back way below intrinsic value and buy a mid-teens returning business.
Now, you have been, as you put it on the conference call, quietly buying oil sands leases. And I'm curious about that. Where are they, and who would you see yourself bringing on to produce on that land?
Yeah, there's a number of really good, well-capitalized private producers that are active on those oil sands permits. Canadian Natural Resources, one of our largest payers as well. And they all do a very good job in those regions. And I think what's happened is with multilateral drilling and better fluid systems, they've found ways to exploit this oil at a very low cost. And some of the finding costs are between $12 and $15 a barrel. So with these narrow differentials that we've seen as more oil goes through Trans Mountain, we've seen an uptick in activity on a lot of those plays. So there are a number of great producers out there, both public and private.
These are all SAGD lands, though. They're not potential mining properties, are they?
Interestingly enough, the viscosities can vary anywhere from 1,000 centipoise to 20,000 centipoise. There are SAGD leases within the area and SAGD production actually on our lands, including Strathcona, who's got a very good asset in Lindbergh. But surrounding that, there's also kind of cold flow potential. So traditional vertically delineated heavy oil pools are now being developed with horizontals, and they're getting far better recovery factors from the existing reservoirs that were known to be there.
I'm not sure if we could show a one-year scorecard for you versus XEG, the energy ETF, and FRU, your rival. You have been outperforming them over the past year, I notice, marginally.
Yeah, and I think, again, one place where we're quite fortunate is with our massive undeveloped land base, which, if you look at a spreadsheet, you never see that land base on the spreadsheet. But that's one of the reasons we've been able to outgrow our peers and outgrow the basin by almost double or triple over the last 3 years, just because we have that big undeveloped land base. So as the capital cycle starts to return, we're able to lease a lot of land to qualified producers, and then we see outsized growth without having to buy new assets. So I think that's one thing that differentiates ourselves from our peers.
Although over 5 years, so you have done better over 1 year marginally, but over 5 years, I'm showing you as underperforming XEG and Freehold.
Okay, yeah, and I think if you drag back to COVID, because we went in with net cash and no debt, I think a lot of people were hurt more than us in COVID, so they would have a better recovery out of that, just because we wouldn't have been pulled down quite as low. But that could be part of it.
Always fun, Andrew. Thank you very much indeed for joining us.
Appreciate you having me. Have a great day.
Andrew Phillips is the CEO of Prairie Sky Royalty.